Hey guys, this is Vic from Grasping the Market and welcome to our market briefing. Uh, as we start the second half of the month, the market has found short-term balance after the sharp rally 2 weeks ago. The consolidation that we see, I have boxed that in this green box, is developing in the vicinity of the 2900 area, and the market seems to be waiting for the two key risk events that we have this week in the form of the FOMC and the G20 meeting. These are the two main drivers that the market has at the moment because of the market pricing rate cuts by the Fed and the potential resolution of a trade deal with China. And the market seems to be waiting for those two events before taking a directional stance. So a breakout to the upside, it's important to remember that will bring into play the previous month high, which coincides with the all-time high, which has no excess whatsoever. So if we start breaking to the upside as a consequence of a positive response to one of these or both of these events, we need to stay ready to probably see the all-time high being tested. Now, when we zoom into the market profile, the current short-term balancing range has shown a few things, and I will list them as follows. We have a clear rejection for the time being above the 2900 area. When we tried to go above, it was smacked down. Then on the overnight, we have another try, and in the open, we sharply went down. So at the moment, we have not accepted above the 2900 area strongly. Now, having said that, the post non-farm payrolls gains, this I have marked here that this was the rally post non-farm payrolls. Those gains are holding, and that's as suggested by the repeated failure for the market to extend lower below that distribution that we left on that day, which is around the 2880 area. Now, at the same time, all the buying activity that we've seen in this past week has been driven by short-term money. And the clear evidence to say that is that we have 5 successive poor lows and incomplete auctions. This is not something that we should take lightly because the money holding this area is short-term money. Friday's profile structure is in particularly weak if we open up because we have 4-week lows. You see the D low almost matching, coming within 1 tick of the A low, then the F period low matching the previous day low, then the J low coming to the I low, and then the M low that matched the L low and halfback. That's a clear evidence that whoever is buying this market is short-term driven. That means that the range lower structure, all this area here, and in particular the low over here and the low from Friday, is not very reliable at all, and it makes it very vulnerable to a break to the downside. Having said that, the session on Friday and the week as a whole ended up with a spike to the upside that tagged the 2900. So our immediate focus for this week is on assessing, for tomorrow is on assessing continuations from this late spike. The base of that spike, I would say, is the early morning high at 2893.75. If we get acceptance within, above that level or above the spike, that increases the odds of a move to the downside. Probably the 2900 will be taken, and that increases the odds of a rotation back to towards the high of the balancing range. On the other hand, if we get acceptance below the early morning high, which is this area over here, that will signal a failure of that late spike, and that will denote change, and that will bring into play the weak structure that we have from Friday, in particular the low. And we need to remain very attentive because if we start breaking to the low, this could accelerate due to the vulnerable structure that we have in place. As I always say, anything can happen because odds are just odds. And in particular, this week, you need to be very tight on your risk ahead of the key events because we will have volatility. Do not get into trades just because you don't want to miss the move. There will be a plenty of opportunity with the volatility that we're expecting this week. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Any opinions, news, research, analysis, prices, or other information offered by Grasping the Market is provided as general market commentary and does not constitute or replace investment advice. Grasping the Market accepts no liability for any loss or damage, including without limitation to any loss of profit which may arise directly or indirectly from the use or reliance on such information.